Y'all ready for this? Let's go.
Welcome back to the Ben James Smith podcast. Today I want to speak more directly than I usually do, not about the market in general, not about abstract capital theory, and not about property as a broad asset class, but about why Rise Capital exists, why the model has been built the way it has, and why I believe this is a moment serious investors should pay close attention to. Because every now and then an opportunity appears that is not simply about backing a project. It is about backing a fund platform before the wider market recognises what that platform can become. And that is the distinction that matters here. This is not a single site raise, it is not a one-off property syndicate, and it is not a speculative bet on one development going right. It is a pre-seed investment into the management company behind a platform being built to launch a £50 million Luxembourg closed-ended hybrid real estate fund focused on UK residential development and value-led acquisitions. The structure is built around deploying both debt and equity, not relying on fragmented deal-by-deal funding. That point matters enormously because most people in property are still looking at projects. Sophisticated capital looks at systems. Most people ask, what is the deal? The better question is, what is the platform capable of doing repeatedly? Rise Capital is being built as a sponsor-led investment platform that originates opportunities, structures and deploys both debt and equity, oversees delivery through third-party professionals, and manages risk through institutional governance. That is a very different model from a traditional developer dependent on external lenders, piecemeal equity, and transaction-by-transaction fundraising. And that is the first reason this is different from most opportunities investors see. The second is timing. The UK housing market is sitting at the intersection of several structural shifts. There is chronic undersupply in UK housing. Traditional banks have retrenched from development lending. Institutional capital is rotating toward residential and living sectors. Mid-market developers remain fragmented and underfunded, and technology-enabled fund infrastructure is making private market access more transparent and scalable. Those are not short-term headlines, they are long-term market conditions. And long-term market conditions are what create durable platforms. So the opportunity here is not simply to participate in housing, it is to participate in building a structure that is designed specifically for this moment. Now let's talk about what really makes Rise Capital different. A lot of investment opportunities rely on one of two things: either a single asset performing well or a manager raising more money every time a new deal appears. This model is different because it is being designed to remove that dependency. The fund structure is a Luxembourg SCSP with a target size of £50 million, combining debt and equity in one framework with annual dividends to investors and future tokenization of LP interests designed into the structure from the outset. That means capital is not being assembled ad hoc each time opportunity appears. It means the platform is being built so capital can be deployed systematically, repeatedly, and under one risk framework. For investors, that changes everything, because once capital is structured properly, the conversation stops being, can this deal be funded? And becomes, should this opportunity be funded? That shift from reactive funding to disciplined allocation is where real advantage begins. The next major difference is economics. Many opportunities look attractive because the project return looks good on paper. But what investors should really care about is how the manager makes money and whether the model can produce recurring income before long-dated exits arrive. That is one of the strongest features in Rise Capital. Rise Capital is not relying on one revenue stream. It is being built around multiple layered sources of income. 2% per annum management fees on committed capital, project level sourcing, debt arrangement and equity structuring fees, interest margin on development debt, a 30% share of SPV development profits, 1% exit profits on development debt, and a 20% performance fee at fund level. That matters because it means the platform is not simply waiting for one big exit to justify itself. It is designed to become an operating business, a cash-flowing asset manager, a real company with recurring income and long-term upside. And that is exactly why this is not just another property raise. A question serious investors should always ask: what is the pre-seed money actually funding? The answer is not vague. The raise is explicitly being used to operationalize the platform before fund launch and support the first 12 months of institutional grade operations. That includes core team and governance, fund administration, legal and structuring, audit and tax, tokenization infrastructure, office and overheads, marketing and investor relations, plus an execution buffer. That is a major point of difference because this capital is not disappearing into speculative land or uncertain construction risk. It is being used to build infrastructure, and infrastructure is what allows capital to scale. Now let's talk about proof. Every serious investor wants to know whether there is something real behind the story. The base case project is Marketplace Swaffham, already acquired and used as the forecasting benchmark. £4 million of fund capital deployed, an 18-month duration, and a blended fund return of circa 19.7% per annum in the base case to the LP fund investors, with Rise Capital also generating sponsor equity profit and carry separately. That is important for two reasons. First, there is already a live reference point for execution. Second, the economics are not being described in the abstract. And when you combine that with the scale plan, the picture becomes much more compelling. Rise Capital's scale assumption is 12 projects using the £50 million fund, one project acquired per month, the same structure as Marketplace, staggered exits from month 22 onwards, and critically, no increase in platform headcount because delivery is fully outsourced at SPV level. That is one of the most attractive features in the whole story. Scale through capital deployment, not fixed staff growth. In other words, operating leverage. That is what drives enterprise value in asset management, and that is why the valuation story becomes very interesting. Rise Capital projects a three-phase cash model. Months 1 to 3 funded by pre-seed. Months 4 to 18 supported by management fees and upfront project fees, such that the platform becomes cash flow positive without relying on exits. And months 19 to 36 supported by monthly project exits, annual carry distributions, interest margin, exit fees, and sponsor profits. So investors are not being asked to believe in a business that only works if everything goes perfectly at the end. They are being shown a model designed to become operationally self-supporting relatively early. That reduces risk materially. Now let's come to one of the most important questions. Why is this not an opportunity investors want to miss? Because once institutional structure, recurring revenue, pipeline and governance are in place, the pricing window changes. The pre-seed is valued as £943,800 for 20% of Rise Capital Asset Management Limited, with indicative valuation upside of £25 to £35 million once the platform reaches stabilised annual EBITDA of approximately £4 to £4.5 million. And that upside excludes future fund upsizing, future funds, and additional strategies. That means this is explicitly a pre-institutional entry point. Investors are not being offered access after the platform is established. They are being offered access while the infrastructure is being built and before the broader market fully prices it. And that is usually where the most asymmetric upside exists. The final point is optionality. This is not framed as a forced exit structure. It gives multiple routes for pre-seed investors, ongoing dividends and long-term income, long-term hold and platform growth, partial liquidity via fund upsizing or secondary sale, and potential strategic investment or a platform sale, with no fixed exit date required. That matters because investor flexibility is often underestimated. A rigid structure can create pressure. An optional structure creates patience, and patient capital is usually the capital that benefits most from compounding. So when I step back and ask what makes this different from other opportunities, the answer is actually very simple. Most opportunities ask you to back a project. This asks you to back a fund platform. Most opportunities rely on one return event. This is built around layered revenue streams. Most opportunities depend on fragmented capital. This is built around institutional structure from day one. Most opportunities are hard to scale without adding more people. This one is designed so scale comes from capital deployment, not headcount. And most importantly, most opportunities are priced after the market understands them. And this one is being offered while it is still being built. That is why this matters. And that is why, for the right investor, this is not simply something to look at. It is something to understand properly before the market catches up to it. Thanks for listening, and remember, the most valuable investments are rarely the ones that look obvious at the end. They are the ones you understood early while everyone else was still looking at the surface. I'll see you in the next episode.